Hey guys, welcome back to the channel. In today's video, I'm going to be showing you guys a package that I recently rediscovered called pair trading. Now this R package is useful to analyze pair trading strategies, which we will go over shortly. But to get this installed, you would need to run line 8 as it is, and then you could run line 9 to load it up along with these other two packages. Now to get started, we need two assets, preferably some that are similar. So in my case, I went with the SPY value ETF and the growth ETF. I wanted to test and see if this pair was mean reverting, and we're going to get data for these two ETFs and extract the adjusted closes. Afterwards, we're just going to combine them into a single XCS object called MAV. And now that these two are combined, we can use our first wrapper inside of this package called estimate parameters, and we're going to pass in the pair, and it's going to estimate our hedge ratio by performing a linear regression on the whole data set. And in line 27, I'm just going to create the spread by subtracting the closing price of my second ETF from the first one, and we'll get to the plot in a minute. But another cool feature that this package has is that we can test if the spread is stationary by passing in a significance level, and I'll show you that printout as well. And what this function will do is it'll return true or false given these two tests. Now from my understanding is that we want both of these to be true, as we would much prefer a stationary spread that reverts back to the mean. So in this case, for my two ETFs, it looks like they are not stationary, and you could view the details from line 34 and 36 down in the console as well, and we see that the p-values are relatively large, which is why these two tests return false. And if we take a look at the actual spread, now to me it looks like it is mean reverting, as we see it fluctuate from about -10 to 10. So for example purposes, let's just continue on with this particular spread and see what other things this package has to offer. So in the next block, we can also perform a linear regression using this function called estimate parameters historically. So from what I got was that this particular function will perform a linear regression every 180 days, whereas the previous function performs a linear regression on the entire history of our spread. And we can also extract our signals using the simple wrapper, where we pass in the spread and we have to tell it where to enter and when to exit. And as I pointed out from the chart, that level seems to be around 10%. So I'm going to go ahead and merge my spread with the signals and also rename the columns. So I'll go ahead and show you what params and the spread looks like. So starting off with params, we have our spread, our hedge ratio, and the premium. Now from reading the documentation, the premium seems to be the y-intercept from the linear regression, and our hedge ratio is just simply the beta. And again, we have our spread here. So since I used a rolling window of 180, it's going to recalculate our hedge ratio and premium every rolling 180 days. And if we take a look at spread, and if we scroll all the way to the bottom here, this is going to switch between -1 and 1 depending on the level that we pass in. So whenever our spread crosses over a -10, it's going to go long until we have another signal at +10 where it's going to go short. So it looks like we've been short for quite a while, so we can go ahead and take a look at the actual chart, and I use high chart to plot it. So if we scroll to the most recent signals, we can see the actual crossover here. So we were long until we crossed over a +10 where it decided to go short, and according to this model, it looks like we haven't had a -10 printout. The closest we got was down here on September 3rd at around -7%, and now it's just kind of hovering around 0. But you can adjust those values if you don't like to use a -10 in line 47. But now that we have our signals, let's go ahead and see what our P&L would look like had we traded this pair. So here in this next block, we're going to lag our signal and our hedge ratio, and we're going to add it to our pairs XCS object. So if we take a look at MAV, we have our pair here, our lag signal, and our hedge ratio, and we're going to use a function from this package called return, where we just pass in our assets, our lag signal, and our lag hedge ratio, and it's going to calculate the return given our entries and exits. And we can use those daily values to calculate our compounded return given this trading model. So here in our equity curve, we see that we start around 100 around 2020 and hitting a high over here around August of 2024. So that was our highest watermark, around 53%, and it looks like we're in a drawdown now. Pairs trading does involve some risk, as we don't know if this will continue to decline, since both of our tests did return that this spread was non-stationary. So in my next video, I'm going to use this package and try to seek two assets that are stationary and see what kind of returns we can get. But for now, I just wanted to give you an overview of this R package in case you wanted to get a head start. But with that, guys, this concludes the video. I hope this was useful information. I'll leave a link down in the description area to my Patreon where you can find this script. Please consider subscribing to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.